Hello and welcome. I'm Blair Blackwell, and this is the Daily Market Brief. Let's catch up on what's moving in markets today.
Good morning. It's Thursday, February 19th, and this is your New York Open Brief. 3 themes setting the tone: a firmer U.S. backdrop keeping the dollar bid, trade imbalances that look stubborn despite tariffs, and rising oil on fresh geopolitical jitters. First, the U.S. data pulse. Weekly jobless claims fell to the lowest level of the year, reinforcing a labor market that looks stable rather than softening. That pairs with Federal Reserve minutes signaling no rush to cut rates. And you can see it in markets. The euro is under pressure, with EUR against the dollar slipping to a 4-week low, and gold is struggling below 5,000 as a stronger greenback caps haven flows despite ongoing tensions. On trade, the story is consistency, not change. The U.S. ran a $901 billion trade deficit in 2025, essentially unchanged even after higher tariffs, while December's gap widened more than expected as imports hit records in parts of the economy. Several reports flag volatile swings in gold and pharmaceuticals as drivers late last year, but the bigger picture is that tariffs haven't materially narrowed the imbalance. Corporate signals fit a nuanced consumer narrative. Walmart delivered a strong quarter and robust e-commerce growth, yet guided more cautiously, calling the backdrop unstable. Grocery inflation is fading, close to price stability in their basket, but general merchandise inflation ticked higher, which could reflect tariff pass-through. Meanwhile, Wayfair logged its first annual sales gain since 2020, outpacing a sluggish furniture market weighed by rates and housing. In Europe, forecasters look for tentative recovery signs in the coming purchasing manager surveys, with a rebound in French services and a marginal lift in German manufacturing, helped by defense procurement. But the UK picture is softer: weak industrial orders, and a Bank of England that's leaning more dovish as unemployment nudges up and wage growth cools. Energy remains a swing factor. Oil is firmer on fears of U.S. strikes on Iran, and Rabobank sees European natural gas demand declining only gradually, a slow burn rather than a cliff. Turning to markets, that mix is supportive for the dollar and risk selective rather than risk on. It pressures the euro and gold and puts a modest bid under crude. Canada is mixed. Home sales slumped on trade uncertainty, but December's trade deficit narrowed with help from gold, leaving the loonie sensitive to oil. Looking ahead, it's a relatively quiet U.S. calendar today, with attention turning to tomorrow's gross domestic product update, where today's trade and inventory figures feed the trackers, and to Eurozone PMIs. You should be watching the euro against the U.S. dollar for a continued downtrend if U.S. data resilience keeps rate cut bets pushed out. The euro against the pound may stay supported if Bank of England cut expectations build. Watch dollar Canada for choppy trade. Oil strength helps the loonie, while U.S. outperformance supports the dollar. Keep an eye on West Texas crude for an uptrend on Iran risk, and gold for a range bound to softer tone under 5,000 as the dollar stays firm. Bottom line, the U.S. looks resilient, trade frictions persist, and geopolitics are quietly propping up energy, a constructive but cautious setup.
That's it for today's edition of the Daily Market Brief. Thanks for listening. I'm Blair Blackwell. This podcast is for informational purposes only and does not constitute financial advice, trading recommendations, or investment guidance.